Morning everyone and welcome to today's first webinar where we're joined by Simon Gergel and Morris-Eyton, managers of the Brunner Investment Trust. Brunner is a global equity strategy with a venerable track record. It survived the Wall Street crash of 1929, the Second World War, the Cold War, and the Great Inflation of the 1970s. So from that perspective, the travails of the world today are familiar ground. Brunner's balanced approach to investing has served it well for many years and has helped it perform well in recent difficult markets. It's among the top performers in the AIC global sector over 3 years, delivering NAV returns of just under 30% and defending that performance well over the last year, during which the average trust in the sector is down 22%. Brunner is down just 5%. Despite this strong performance, the trust remains at a discount of 12%, wider than the peer group average of 8%, making this an interesting time for us to take a look. The microphones are muted, but you can ask questions by using the Q&A function, which you should be able to see at the bottom of your screen. I'll put your questions to the team at the end of the session, so please do make use of that function. Over to you guys.
Good morning, everybody. Delighted to be here. My name's Simon Gergel, and I'm joined by Morris-Eyton, here to talk about the Brunner Investment Trust. So to go straight into this, the Brunner Investment Trust has been around for 95 years. It's an equity-orientated trust. And the philosophy is fairly simple. We try to buy good quality companies, but we have a balanced portfolio. So we're balancing between growth and value, which are both important to us. And we're trying to deliver consistent returns with that approach. We focus very much on two objectives. One is capital growth. To achieve that, we have an actively managed global equity portfolio, which is managed with high conviction. We have concentrated high conviction positions to deliver that performance, and we have, as Pascal said, we have a strong track record. We also have an income objective. We have one of the highest yields in the sector, and the dividend has grown every single year for 50 consecutive years, which is a key objective of the trust. And there's a large team. There's a team of fund managers running the Brunner Trust, but surrounded by us, we have a large team of investment professionals, and we'll talk about that. We've got significant resources we can draw upon from Allianz Global Investors. So if I now turn to the two objectives of the trust, the first is income and dividend growth. You can see here the 50 years of dividend growth of Brunner. One of the great things about investment trusts is the board of directors can put money away in good years to dip into those reserves in tough times. So the income we generate can be spread over time, and that allows the trust to have many years of consecutive dividend growth. And you can see that on this chart. We show in green where the directors have put money away into reserves, and in red where they have drawn on those reserves to keep growing the dividend. And that's worked very well through the pandemic and other periods of dislocation before that. The dividend is paid quarterly, and there are still over a year's dividends in reserves, 24.7 pence in reserves. So there's over a year of dividends in reserves for a rainy day. Dividends have also grown above inflation in the long term, which is a record we're very proud of as well. The second objective is clearly capital return or total return, as we show here. And we show the return here at the NAV, net asset value, and also the share price compared to the benchmark. The benchmark is 70% global equities and 30% UK equities, and the performance has been well ahead of that over the last 10 years, as you can see here. So that's a very brief introduction. Marcus is now going to talk about what we look for in the companies to deliver that performance and that income, and then I'll come back a bit later on. So without further ado, over to you, Marcus.
Thanks, Simon, and good morning, everyone, from my side. With regards to the investment philosophy, one of the strengths of Brunner is it's really been employing the same clear investment approach for most of its duration. And what we're trying to do with Brunner is really invest at the intersection that you see there of quality, growth, and value. So to dig into each of these terms in slightly more detail, because I appreciate they can be generic and have different meanings to different investors. But from a quality perspective, we're really trying to invest in high quality companies with long-term sustainable competitive advantages. And they can clearly range from industry to industry, but are typically factors like a brand or a product or even a service superiority. So later we'll discuss LVMH And clearly the competitive advantage comes from the Louis Vuitton brand that they've curated over the centuries. We invest in companies with good balance sheets, with high barriers to entry, with good management teams that we know and trust, and have a track record of strong execution. And ultimately companies that this all materializes in decent and hopefully growing returns on invested capital. From a growth perspective, we're looking for companies that are exposed to growing end markets, and we're not thematic investors. But as we'll show later, there are certain themes that certainly permeate this portfolio. And we'll speak about digitalization and energy and sustainability as we go on. But ultimately, we're investing in companies that are not at the whim of the wider market. And many of our companies' growth drivers are independent of the macro, which has enabled them to stay in control of their own destiny. From the metrics we use, and those metrics depend on the maturity of the business, but also the industry that they're exposed to. But ultimately, the PE of the portfolio is about 16 times, so marginally above the wider market. But for that, you get double the growth of the wider market and also double the returns. So you can see how that slight valuation premium it comes through in both the quality and growth of the portfolio. Simon, if we go one slide further on, here we mention ESG, and to be very transparent, this is not an ESG dedicated fund, but what I would say is all of the portfolio managers, we have a very clear view that ESG risks are now fully integrated in all the investment decisions that we make. So whenever we are analysing a company, we are assessing from a bottom-up perspective both the risks, but equally, and I think this is important to emphasise, the opportunities that ESG might provide. And there are many examples, again, that we'll discuss, companies like Schneider Electric, DCC, who are actually benefiting from whether it is that energy transition, for example. So that's something that we're paying very close attention to in all our investment cases. And lastly, we're very fortunate at AGI that we have a huge stewardship and ESG team. So not only are we engaging with all of our companies regularly, but we're also closely monitoring the various proxies. And I think that there's a huge benefit to that as a long-term investor. One slide on, Simon, if we may.
Sure. Sorry.
This slide is an important one because in the introduction, Pascal mentioned how with Brunner, we're not trying to be the raciest or the most glamorous global portfolio, but ultimately we are trying to construct a portfolio that can outperform in most market environments, and we call it an all-weather strategy. So we are not investing typically in the very high, rapid or emerging growth companies. So you won't be surprised to know that we don't own and never have owned the likes of Tesla, etc. And that we suffered from that at the beginning of the COVID crisis. But ultimately, we're investing in stable, well-run, profitable, moderately growing businesses. And I said our average EPS growth in the trust is generally about 10-11%. And then selling those businesses before they go into decline. So I said it is a core solid growth portfolio rather than chasing the super highly valued riskier growth that you find in various other strategies. One slide on. In terms of the investment team, as Simon mentioned at the beginning, we have, well, what used to be 3 and is now 4 portfolio managers, and we'll discuss those in detail shortly. But we're actually very fortunate to be surrounded by a wide resource base and, importantly, an experienced resource base with various different style attributes. So starting with Simon, many of you will know Simon. He is the CIO of UK Equities at Allianz Global Investors, and also heads up our value and dividend team. And many of you may be aware that he also runs the Merchants Investment Trust, which, to put some praise on Simon, just won Investment Trust of the Year in the UK income category. So he's doing astoundingly well there. But Simon's background, as you see, is very much in the UK. Christian, who is currently the lead manager on Brunner, he's been with Allianz for the past 22 years and has spent the bulk of that time running global portfolios. And then myself, I'm a relatively newbie, only been at Allianz for 11 and a half years, and I sit within our global growth team, but run European products primarily. So hopefully we have a few owners on the call of Allianz Continental European, or UK OIC. And last but not least, the face we're missing on the slide is Julian Bishop, who joined us 8 days ago from Tesco and previously Saracen, where he was running global money, and importantly has a very clear and similar investment philosophy to how the Brunner Trust is run. So hopefully next year, many of you will be meeting Julian in person once he's got his feet under the table. But really on this slide, I think the key message is reinforcing the resources we've got around us. This isn't just the 4 PMs. This is the Allianz Global Investors wider portfolio platform. And you see global teams, you see UK teams, you see European teams, you see growth investors, you see value investors, as well as our ESG team, which now comprises close to 50 people globally. We also have grassroots research, which I'm sure many of you are familiar with. And just to give one very brief example on that, our biggest problem stock of the year has been Adidas, which has suffered from some brand and reputational issues in China. So we've recently commissioned grassroots reports, which is actually speaking to consumers and retailers on the ground in China to understand their perception of really what is happening on the ground in that region. And those are the types of reports we get that are almost unlike anything else in the industry, because they are completely balanced and neutral, with no incentives to encourage us to trade or have a view in one direction or another. So those are the types of reports we often run for many of our holdings where it's appropriate. So I think with that, over to you, Simon.
Thanks, Marcus, and thanks for that that description of the team. And yeah, delighted to have Julian joining us as well. And I'm sure in the new year, many of you will have a chance to hear from him as well. Apologise, I did sort of slip of the tongue earlier when I mentioned merchants instead of Brunner. I tend to get confused sometimes, but no, I'm delighted to be involved in the Brunner as well, and to help on the UK equity side of that. So that's the team, that's the resource. I'm going to talk now a little bit about the process we operate under. So we start really with a funnel. We start with 6,000 stocks in the investable universe of stocks globally. So it's a large number of companies, but we whittle that down. We use the extensive resource team, research resources, and the portfolio management teams we've got at Allianz Global Investors to find the best companies we can find. And the great thing about having so much choice is we can really be picky. We can look for those characteristics that we're looking for and be very selective. We have a lot of internal resources, but we also look at external resources as well. We're not too proud to say that there aren't ideas coming from outside that we can take advantage of. We funnel that down, as Marcus said, between quality, growth, and valuation, focusing very heavily on quality, but the other two aspects are really important as well. And we try to build that into a portfolio of 60 to 80 stocks. We want to be fully invested. We're not running with cash in the portfolio, not a significant amount of cash. We've got a modest level of gearing, but we find 60 to 80 stocks is the right amount to give us a diversification, to give us a balance between different styles and different factors, such as cyclicals, defensives, different countries, different sectors. What we're trying to do really is deliver a portfolio that's going to perform through stock selection, through picking individual companies, rather than the more binary calls of trying to predict where the economy is going to go, or maybe which region is going to outperform another. That's quite difficult to get right consistently. Whereas if you've got 60 to 80 stocks and you get most of them right, you can deliver more consistent performance. So we have high active share, a portfolio that's very different from the benchmark, but we're trying to deliver most of the performance from stock selection. And an aspect that's just as important as the buy decision is the sell decision. You can make or lose as much money from selling a company well or badly as you can from buying it well or badly. And again, the sell discipline is driven by three things. Ideally, if the shares do well, the valuation goes up to the level we think is full, then we may well sell it. If there's a change in the investment case, and that could be any aspect of the investment case, the fundamentals, the quality side of it, the growth side of it, we will review that very, very rigorously and decide on that. And sometimes there's simply better opportunities with 6,000 shares to choose from. there are often new ideas that come along and you think, well, this is a better one than one of the others. So that's the stock selection process. And then just to, probably worth saying a word about the geographic exposure. So we have a benchmark of 70% global equities, 30% UK equities, but the underlying exposures are pretty well balanced. Even the UK stock market is a very well balanced market. If you look at the UK, the majority of profits and sales of UK listed companies comes from abroad. And if you look at our portfolio, we've got about 41% in North America, about a third in Europe, and about a third elsewhere, or just under a third elsewhere. And that, I think, is a good balance to have. The North American market, the US market, US economy is probably going to deliver more resilient growth in the next few years because it's more energy self-sufficient as an economy, and also it's more self-sufficient generally as an economy, actually, in terms of trade. So the US economy is not as vulnerable to, for example, the price spikes we've seen in the energy markets in recent months. So we think US is a good place to be, but there are opportunities all over the world, and the portfolio is quite well balanced. Sorry, I'll hand back to you, Marcus. Do you want to talk about digitalization as a theme?
Yeah, thank you. I mentioned earlier how we weren't thematic investors, but there were certainly various themes that permeated the portfolio. And here we've actually listed some of the companies we have that are exposed to that digitalization theme. And I think what's most remarkable is when people think of digitalization, they naturally think of the tech sector. But what you see here is how it spans almost every sector across multiple companies that we're investing in. So if you look at the tech sector, everyone will be familiar with the likes of Microsoft and Adobe, which we're probably all using right now. But the other companies like TSMC, which is arguably the world's most important company to future global growth. And they have a market share of 57% in semiconductor manufacturing. And that market share becomes even higher when you look at many of the leading smaller edge nodes that are currently driving digitalization. And actually, to put this into context, TSMC's annual capex budget is 42 billion. And many will have heard that the US and European Union just passed a Semiconductor Chips Act to try and grow the semiconductor industry both in the US and Europe. Those chip acts are both 12 billion per annum. So they are dwarfed by the size of TSMC's annual capex budget. And because of the scale advantages they've got, their margins and profitability are double that of their closest competitor. And there are now really only 3 companies that are competing at those leading edge nodes. In the financial space, we've got Intuit, who is both B2B and B2C. Many of you will have probably used Intuit products before, but they are essentially the leading provider of DIY tax and accountancy software. So not something that we particularly associate with fun and pleasurable times, but they are the market leader there. It's a very recurring business model, because once you've signed up for Intuit and you have your tax and accountancy loaded up on there, it's very cumbersome and time consuming to change. So it's a very recurring revenue system, and I mean, their financial performance has been superb. They've grown double digits CAGR over the last 10 years. This year, they've grown at 32% and guided to grow again at double digits for next year. And what's attractive here is, unfortunately, in a recession or in a bull market, we still need to file tax returns. So it's a very sticky business that's not overly exposed to the wider macro environment. In the consumer side, just briefly, we've got Baltic Classifieds, which in many ways, to put it simplistically, is a Baltic version of Rightmove and Auto Trader combined. They are 12 times the size of their nearest competitors in those markets. And those markets are at a much earlier journey than we are in the UK in terms of monetizing that growth. In the industrial space, we've got companies like Schneider Electric, and we speak about digitalization, but it's actually companies like Schneider that are creating the infrastructure architecture in place in terms of their low and medium voltage solutions that are really enabling this transition to happen. And then in the healthcare sector, there are many examples, but probably the most interesting is a US company called Intuitive Surgical, and they are the world market leader in robotic surgery. And there's no doubt that over time, more and more of the market will gravitate in that direction. And Intuitive Surgical with their Da Vinci robot system are probably the most interestingly positioned out of all companies in that space. So if we go ahead one slide, another theme we've spoken about in the past is healthcare, and particularly the demographics, which don't make for particularly favourable reading in much of the developed world. And if we look at the slide on the left of the chart, this slide shows the number of old age dependents, and what that really means is it's the percentage, well, the number of people aged over 65, so at retirement age, divided by the working age population. And unfortunately, as you see, the Western world is aging, and over the next really 30 years, we will see a 15% increase in the number, the percentage of the population over 65% in Europe, the US, and also Australia and New Zealand. So the Western world is aging, but the good news is that incomes are rising, and what that means is we expect to see more and more money, but both at a consumer level, but also at a government level, directed towards the healthcare system. And if you flip forward one slide, Simon, much like we just discussed with digitalization, this isn't purely treatment and diagnosis. The healthcare category is much, much broader than many people probably initially imagine. In the US in particular, you have a very large insurance subsector, and there we have companies like United Health and also AIA in Asia. The diagnosis companies, many of you will be familiar with, like Roche and Agilent. And then on the treatment side, we discussed Intuitive, but it's also companies like Cooper companies. I wear contact lenses, so I use Cooper contact lenses virtually every day. But they also have a very successful IVF franchise, which unfortunately, as fertility rates in much of the Western world are declining as we have children later, again, is a high growth area for Cooper. Ecolab are focused on really hygiene and preventative hygiene and the outpatient categories. And then the aftercare, this is a beautiful segment where you have customers generally for multi-years or often decades. So Novo Nordisk is a key holding here. They are the global market leader in diabetes care. But perhaps more interestingly, the new growth engine for the company is really obesity, where they have created a very, very promising drug that is taking market share quite aggressively in the US obesity market. And I won't make any comments about US and obesity, but it's clearly a growing market with huge opportunity there. Over to you, Simon.
Thanks, Marcus. So another theme of growth is the whole area of energy. Now, the global demand for energy is not growing that fast. It is growing, but modest average growth. And with energy efficiency, that growth hopefully will be even lower in the future because we need to be more efficient with the energy we use. But that big picture does mask a couple of interesting trends. The first is clearly there's a massive push to grow energy production from renewable power sources. And there's huge potential growth in that industry, that part of the industry. And the other thing, there's a massive growth in electrification. Electric vehicles are going to take over from internal combustion engines. And we need to move that electricity around the networks. We're going to have homes aren't going to be heated by gas in the future. So there's going to be a lot more electrification. And that both of those themes drive opportunities for investment. And it's not just investment in very high growth, very highly valued stocks. There's plenty of companies that offer a good combination of good quality, good growth, and a sensible valuation. And we look at sort of 4 different areas. There's clearly the resource companies like Shell and Total making oil and gas, but also transitioning their businesses into renewables, into other areas like that in terms of the whole electricity value chain. Companies like Rio Tinto making aluminium, which is critical for the energy transition. On the industrial side, there are companies that control the whole building environment, the way that electricity is used in buildings, in workplaces, to control and move that around and to become more energy efficient in building management. And there's a lot of scope to reduce emissions by becoming more efficient in the way we use energy. And then the purer area is the generation of power. There's companies like Iberdrola, building out renewable power generation. And then on the transmission, Marcus mentioned Schneider, but there's also companies like SSE, which is both building renewable power stations with wind farms, but also moving electricity around, electricity transmission and distribution around the network. And both of those activities are growing very fast. So there's a lot of areas here where there's potential to get exposure to growth, but at very sensible valuations. And just to give you one example in a bit more detail now, because we've talked sort of a bit big picture. If we take a company like Unilever, many of you will know Unilever, products like Marmite, Ben & Jerry's ice cream, Dove, skincare products. It's a high quality business. It's got a fantastic position in emerging markets, which is, it's got probably the strongest position of any consumer goods company in emerging markets. And long-term emerging markets should show better growth, both in terms of population, but also in terms of the wealth. As people get more wealthy, they're more likely to buy the type of products that Unilever manufactures and distributes. So we see good long-term growth from this company. The shares have been trading, when we bought them, at a sensible valuation. They've traded at a discount to many of their peers, and that's given opportunities to buy a good company, good quality, high return business with good long-term growth at a sensible valuation. And the company's actually got a great record of passing on cost increases through pricing over time and maintaining very high margins. And it's also got a very good sustainability profile. It's been a pioneer in some of these areas, and this takes that whole area of sustainability incredibly seriously in the business. So that's just an example of a company that meets the criteria of quality, growth, and valuation. I think Marcus would like to give one more example.
Yeah, a slightly more glamorous one in many ways. I mean, here we've got LVMH, who many of you will be familiar with, their brand portfolio. So they have about 85 brands, but perhaps the best known ones are Louis Vuitton, Moet, and Hennessy, as you see in LVMH. But they've also got brands like Bulgari, Fendi, Tag Heuer, etc. And it's really an example of a company that has dominated a category, but has continued to benefit from really their market leadership brand portfolio to be able to continue to grow market share. And so they've grown at 20% this year organically. And when you consider both that we've been in a consumer recession for much of this year in their key markets, but also secondly, that their most important market with 30% of revenues is China. And much of China has been locked down for parts of this year. So that really is an astonishing growth rate. And that's something that we've seen now for a couple of years in a row. So their fashion and leather goods category, which is the most important segment within LVMH, that segment is now bigger than the whole of the rest of the group of LVMH was going into COVID. So they've organically compounded their revenue growth over the last 3 years at over 20% during a COVID crisis, which is really quite remarkable. And during that period, they've been able to add 5% to their operating margins. So they're outgrowing the market, they're increasing profitability, and they're gaining market share in a growing market. And ultimately, the valuation has come back slightly. So the stock's currently trading at a PE multiple of 20 times, which, when you consider the metrics I just mentioned, we think is quite reasonable and actually pretty attractive. Just briefly on outlook, because we will all have our own individual outlooks, and the Brunner Investment Trust is not a macro-driven portfolio. We're investing in bottom-up fundamentals. And in many ways, the macro picture will be dominated by what happens, today in the US elections, but probably more pertinently in the interlinked issues of inflation globally and the central bank response to that. And there will be a number of factors that could heavily influence that over the coming months. So we are not in the game of trying to predict what inflation numbers will be on Thursday in the US, for example, and the central bank response to that. One of the beauties of the Brunner Investment Trust is really by investing in good quality companies with their own growth profile very much in their control. We aren't as at the whim of the wider macroeconomy as many other portfolios would be. So we're beginning to clearly see the signs of a corporate slowdown. We're now towards the end of the Q3 earnings season, and it's certainly evident that we are seeing many more profit warnings across the market than we did in Q2. In Q2, they were very much dominated by the consumer sectors, where over 60% of all profit warnings were in the consumer sector. It is much more widespread now. So we really do expect the quality profile of companies to become ever more important. And if you think of the macro backdrop we're likely to move into in the coming years, one of high inflation, probably slightly higher rates, but lower economic growth, you want companies with strong balance sheets, with good pricing power, who can generate much of that growth internally. And lastly, from a valuation perspective, I'm not going to sit here and try and call the bottom, but ultimately I think we are at quite an interesting point at the moment in the cycle. Valuations across the board have come back quite materially in places, and certainly we're able to find, on an idiosyncratic basis, some pretty interesting ideas at the moment. And so lastly, on the final slide, just wrapping up, I think hopefully over the last half an hour, Simon and I have given you a good idea of the relatively unique investment philosophy that Brunner has got. And Brunner will probably not be your raciest global fund, but equally, it has a very strong track record of both capital and income growth. And I think the performance over the last couple of years is really testament to that. This is an all-weather approach that can hopefully outperform in most market environments by investing in good quality, growing companies at reasonable valuations. So with that, I think Simon and I would open it up to any questions that Pascal or the clients on the call may have.
There's a couple have come through. I don't know if Pascal, you want us to go straight into that, or do you want to?
Yeah, so I've got a few here as well. Just a sec while I stop pressing the wrong button. Okay. Hi guys. Yeah, we have a few questions, but by all means, while we're going through these, if anyone else has questions you want to submit, make use of the button down the bottom there that allows you to do so. So starting at the top, it's been a tough year for investors. The share price for Brunner has fallen over the last 12 months as the discount is widened. Can you see any light at the end of the tunnel, or is there plenty more tunnel yet to come?
Shall I start, and then Marcus may want to add? I mean, Marcus has already talked about one potential light, which is the valuations are much more interesting now across the markets than they were, much more attractive generally. I think the other thing is, though, if you think about what's been driving concern in the market, it's been the massive spike in inflation and the response of central banks raising interest rates, and really the bond yields going from virtually zero, and interest rates from virtually zero to much higher levels, 3%, 4%, 5%, and people are worrying about getting on top of that. I think if we look forward 6 months, we're already starting to see some of those inflationary pressures potentially easing. So the oil price has fallen from $110 to $90 or so. The freight rates, which were a big cost for many businesses, have come down dramatically from where they were. They're almost back to where they were before the pandemic. The gas price in Europe has eased, although to be fair, we are early in the winter. That could go back up again. But many of the other commodity costs, I saw a company last week and they said apart from lithium, most of the costs they've got have actually come back a long way now. So a lot of those inflationary pressures are starting to annualize out, and therefore clearly wages are going up and labour costs are going up. But if you look forward, the inflation rate should at some point start to peak and then potentially come down. And if the economy does slow, as many people think we are slowing right now, the pressure on central banks will quite quickly move from one of how quickly can you raise interest rates to get on top of this, to at what point do you need to stabilise and potentially even start to bring rates down. I mean, the US is further advanced than elsewhere. The UK is catching up and Europe's behind. But it's probably on a 3 to 6 month view, we will be talking about when interest rates peak and when interest rates potentially start to come down again. And that's usually a more positive environment for investors. So I think we are quite close to peak fear, peak pessimism at the moment in terms of the macro side. Markets, as Marcus said, it's very hard to call when markets move, and I wouldn't want to try and second guess that. But if you've got markets that are sensibly priced and stocks within that are attractively priced, and you've got the potential for that we're near the worst point in terms of fear, I think that's a good combination on a long-term basis to be investing. But calling it is very, very hard. I don't know, Marcus, you want to add anything?
No, I think you've nailed it there. All I would say is whether there's light at the end of the tunnel really depends on how long your tunnel is. And as said earlier, we're long-term investors. There are many factors that could influence the short term, But ultimately, as both Simon and I have said, when I look at the portfolio and the wider market today, we are recognising more and more interesting opportunities that have fallen quite significantly, where actually the fundamental outlook looks relatively robust. And I think there will become a time in the coming months or quarters when the Fed pivots. Virtually everyone you speak to in the market is currently bearish, and as numbers come down, I think there is opportunities for upside surprises from them.
Thanks, guys. There's a few questions about your sort of regional allocations. There's one about Europe and why you have what the person asking the question describes as a relatively high weighting to Europe, why you're comfortable with that. But also, I'd like to tie into that a question about the US, which ties into what you've already said. But if given the dollar's sort of strength of the dollar's run, obviously your exposure to the US has that dollar exposure as part of it. If the dollar were to stop running and perhaps lose ground, how does that affect you? So if you could combine the answers, or answer both questions at the same time, given they're both kind of regional questions. Firstly, why Europe, and also what's the impact of the dollar not being as strong as it has been?
Do you want to start?
Yeah, I can maybe make a start, and there are many questions within that. So to start with the UK and European weight, in the strategy, we currently have about 22% of the portfolio based in the UK, which is an 8% underweight relative to the benchmark. With regards to Europe, we do have an overweight. That's 27% of the fund is based in Europe ex-UK, as we now categorise it. That has historically been a bit of a structural overweight, and our stock picking in Europe historically has generally been relatively good. But equally, we need to remember that these are not domestic European companies in many instances, and that's interlinked really to the dollar-related question. Because although we are underweight in the US, many of our companies have material revenue streams in the US or US dollar denominated territories. So a lot of our companies, for example, particularly in the industrial space, companies like Atlas Copco and Assa Abloy, are initially from the Nordics, but have now exported that success overseas. They've had a huge tailwind this year in terms of at least their local currency reported earnings from converting US dollar denominated earnings back into local currencies. So generally these things tend to come out in the wash, because you lose on the share price side, but you gain on the revenue side. I don't know if there's anything Simon would like to add.
Well, there's a couple of questions about the UK allocation as well, and it's probably worth saying that the benchmark is 70% global, 30% UK. One of the reasons for that is historically UK companies have paid higher dividend yields, higher income, and very reliable income. So dividends are taken very seriously in the UK market, probably more so than some of the other markets around the world. There's a long tradition. So if you are trying to deliver both capital growth and also income, having a decent allocation to the UK does make some sense. Having said that, many UK companies are very international. Within our portfolio, we've got companies like Unilever, Haleon, which is the over-the-counter pharmaceutical product, over-the-counter consumer products part of Glaxo, which has been spun out. Even a company like S3, which is a recruitment company in the tech area, that's a very global business. So even though companies might be listed in the UK and might be paying good dividends, and there's a high commitment to dividends, that doesn't mean their operations are purely in the UK. So although the UK may be a relatively large part of the benchmark, the businesses there that we own are often global businesses as well. And so the allocation is to try and give a mixture of decent amount of income, but also good capital growth as well. And I suppose the final thing is having slightly greater UK allocation than might be in the global benchmark does help in terms of currency, because it gives a bit less currency exposure on the dividends you get. Even though companies are global, if they pay dividends in sterling, they're more likely to be growing those dividends in sterling rather than having currency volatility on the income stream as well. So that's probably the final angle.
Thanks, guys. There's just a couple here I'd like to ask about the trust's sort of ability to perform during downturns. Is any segment of the portfolio specifically designed to deliver capital protection or negative correlation to mainstream kind of equities? moves in contrasting direction to indices. And in a recessionary environment, or where you talked about the idea that inflation may begin to be less of an issue as economies slow down, what parts of the portfolio are best equipped to perform?
Yeah, it's a big question. I think some of it, when we look at individual companies, we do like to look at those type of features. So a company like IG Group, for example, which is a financial trading, personal trading business, benefits from volatility. Although we don't know how they've traded for the last 2 months because they haven't announced it, but it's almost certain they've had a very, very strong performance of trading because there's been so much volatility in markets. So when markets go down, you tend to find volatility goes up and trading in shares goes up. So that's one example of a company that tends to be a little bit counter-cyclical in terms of their operations. But as Marcus said, a lot of it is about having companies that fundamentally have got good growth profiles and resilient, good quality businesses that can push pricing through as inflation picks up, and maintaining a balance. I don't know if you want to add to that, Marcus.
Yeah, possibly, and it's linked to one of the earlier questions which has come through in terms of our industrials weight. And if you remember the slide we showed at the beginning, which showed the various different segments of growth, we are not looking for rapid growth. We are looking for core, repeatable, sustainable growth through a cycle. They're categorized as stable growth. So although we have 21% of the fund in the industrials sector, these are generally much more defensive business models than you would typically expect. So one example would be Assa Abloy, which I just mentioned, which is the market leader in electromechanical locks and keys with many brands that we'd all be familiar with. So 2/3 of their revenues come from the aftermarket side. And again, 52% of their revenues come from the US. So you currently have the tailwind from the US dollar. You have a better macro backdrop in the US. But ultimately, also, you are protected in a downturn, because this is a company that has always been able to generate reasonable organic growth, regardless of how tricky the overall backdrop is. The flip side is if we are going into a bull market with huge global growth, the likes of Assa Abloy will likely lag that in the shorter term. But I think that gives you an insight into the way we think. It's really looking on a company by company basis, making sure we're investing in companies with sound business models that aren't overly exposed to one particular macro scenario, because you can be sure that macro scenario will change many times over our investment horizon.
Thanks, Marcus. Moving on to China, has your attitude to China sensitive companies in the portfolio changed as a result of the sort of changing personality of China from a global investor's perspective? So things like the COVID response and the saber rattling over Taiwan, obviously negative headlines surrounding China are a lot more common than they used to be. How has that affected your perception of the companies you have? And you talked about LV and their exposures to China, things like that.
Yeah, it's an interesting question, and one that we debate extensively ourselves. And again, this is one of the benefits of working for a big global firm like Allianz Global Investors that have a footprint in both Hong Kong and China. Every Wednesday in our team call, various portfolio managers from Hong Kong join that call, and they're able to give us the local perspective, which is sometimes slightly different from what we hear and read on the ground here in Europe or in the US. But to answer your question, there is no doubt that the narrative around China has and will continue to change. We don't own or have much direct China exposure in the strategy, but ultimately we do have several companies in the fund that generate a material part of their revenue growth from China, and that's natural in a growth fund. And what we are trying to understand is really how strong the barriers to entry are for those companies, because where it's possible, President Xi will certainly try and prioritize local competition in the place of those. So I think it's more important than ever to make sure that the products you are selling in China are not copyable and are really critical to that local infrastructure. So to use the consumer example, you mentioned just then, Pascal, LVMH. It's much easier for China to copy a company like, take Inditex or Zara, or Next in many ways in China, than it is for a company like LVMH, which has been around since the 1850s and has 170 years of heritage that you cannot create overnight. So we're really focusing and making sure that our China exposure is the right China exposure, and is fit for President Xi's new narrative around China v. the West.
Thanks, guys. Okay, so there's a couple of questions around the sort of management of the company, and obviously there have been some management changes. One question is, will the kind of new manager's kind of appointment have any impact? Is there any change to the way the portfolio will be run? And the other is how what assurance can be provided about the way the managers are locked into the company? You know, what's your kind of is there skin in the game, or what's the kind of program in that respect?
Maybe I can start with that. I
Yeah.
mean, if you look at the three people, well, let me go back to the slide that Marcus showed earlier, where I can give you some reassurance, I suppose, is that, let me find it, here we are. Myself, Christian and Marcus have all been with Allianz Global Investors for a very long time. I've been here 16 years. I think Christian is longer than that. And Marcus, I think you said 11, is it?
Yeah.
So we've all been with Allianz Global Investors for a long time. Even Matthew Tillett, who was the manager, had been with us for a long time. So we are able to keep people for a long period of time. It was unfortunate that Matthew Tillett left, but to be fair to him, he'd been with Allianz Global Investors as his first ever job. He'd been with us 16 years. He'd done a great job, and both in the UK portfolios he ran, but also in the Brunner. And I think he was at that stage of his career where he was looking for a new challenge. But we're delighted to bring in Julian. I think Julian, the Brunner is run as a team approach. So what you get is a good exposure to the various teams, as Marcus said earlier. We got expertise from the global growth team, from the dividend and value team in UK equities, and bringing Julian into that, you're getting a stronger team approach where there's 3 or 4 people actually working together to build the portfolios to give you that reassurance that should somebody leave, there is a team around that, behind that. And of course, there's enormous depth in the surrounding teams in terms of expertise and longevity. So I understand where the question's coming from. I think we've worked very hard, both in terms of Christian, who's been doing a lot of recruitment, but also our global CIO, equity CIO, who's been involved in the recruitment, to bring in somebody who's got an investment style that is very well suited to what Brunner's trying to achieve. And we think that the team should be a strong and stable team to deliver that. But it's always a very difficult question to answer that, because you never quite know what's going to happen in the future. But we've worked very well to bring in people who are committed to what we're doing in Brunner, and who've worked together for a long time with the addition of Julian. I don't know, Marcus, if you.
No, I think you said all the key points, and as you said, the 3 of us have been there for many years, and equally, it's the team behind the teams behind the team. You see our faces on the slide, but actually, there's a lot of input from the other teams that we're all part of. And just one comment on Julian, because there was a question in terms of the comfort of keeping the investment process. And we were very clear when we were looking for candidates to join the Brunner team that we wanted someone who fully subscribed to the existing investment process. If we look at Julian's track record running money, there is a very, very clear overlap, what he's done elsewhere, to the Brunner Investment Trust. So I think that process will remain as pure and clear as it has done.
Great stuff, guys. We are running low on time, but if you've got time for 2 more questions?
I do.
Yep. So we've got a couple from one of our analysts here who I think they're quite interesting questions. Is do you expect growth or value to outperform when the rate cycle peaks? The first question. The second is the UK a basket case, or are some companies benefiting from weak sterling? And if so, are you taking advantage of that?
Shall I take the growth v value one time and you do the sterling?
Sure.
Well, you'll hear different answers. I'm a growth investor. Simon is a value investor. So I can't tell you the number of times over the past decade that we have debated this. And in all honesty, I think there is no right answer, and I'm not of the view that either growth or value will outperform. I think it's possible to outperform in either style by investing in great companies that are growing at sensible valuations, and that's really what we're trying to do here in Brunner. And we're not overly skewed to one particular style, as we showed in that process slide at the beginning. So I'm sitting slightly on the fence here, but that really is the point with Brunner. That you don't need one of the styles to be strongly outperforming. It's an all-weather strategy for most market environments.
Yeah, that's a very diplomatic answer. I think even as a value investor, I would acknowledge that value is not just price. Value is about buying good quality businesses when they're cheap. And you know what Brunner's trying to do is to do that as well. It's trying to buy good quality companies at sensible prices. So it has an element of valuation as well as growth in it. In terms of the UK, I think the question is the UK a basket case or something along those lines. I think that's harsh. I think if you look at the UK's performance, clearly since the Brexit referendum, the UK as a stock market has been underperforming and getting cheaper. The UK as an economy hasn't been dramatically different to much of Europe, and the sterling has it's weakened since the Brexit referendum, but actually the last 2 or 3 years it's been broadly similar to other currencies. The big feature of currency markets has been the strength of the dollar. I don't think the UK economy is a basket case, but also I would emphasize that the companies we own, as I said a couple of times already, are very global in their nature. They may be listed in the UK, but the UK stock market is a very global market. So there are some really good businesses that are domestic in the UK, but there's also many global businesses that happen to be listed for historic reasons in the UK. So I think we've got to be a bit careful not to fall into the trap of thinking 22% of the portfolio in the UK market means we've got 22% exposure to the UK economy. That wouldn't be fair.
Brilliant, guys. Thank you very much. Really interesting answers. I think that really is all we've got time for. We have another session at 1 o'clock. So if you are in the audience and you'd like to attend that, there's plenty of time to register. Just if you look at the homepage of the website, you'll see it's quite easy to log on. I don't think you even need to register at this point. You can just sort of get in. But in the meantime, I'd like to thank you both, Marcus and Simon, for the insight. Thank you all for joining us today, and I wish you all a very pleasant afternoon.
Thank you very much.
Bye.
Bye.